Welcome to the deep dive. Today we're tackling something pretty fundamental, how companies in extractive industries, mining, oil, gas, how they report their profits. And the core issue? Well, it seems to be baked right into the accounting rules we use globally.
That's right. Under the current standards, GAAP, IFRS, these companies often look, frankly, a lot healthier than they really are.
Why is that? What's the mechanism there?
Well, essentially, they get to treat the money they make from selling off a finite resource, something that won't ever come back, as if it's just regular operating profit.
Right. It's like selling off your family silver and calling it your salary for the month. Doesn't quite track, does it?
It's a systemic illusion, really. And that's what we're diving into today, a pretty radical proposed fix called user cost accounting. It's a framework designed to, strip away that illusion. It forces companies to face the economic depreciation of their natural capital.
And crucially,
It demands they actually set aside funds specifically for replacing that capital in the future, planning ahead.
So this isn't just a theoretical exercise. Where do these ideas come from?
They build on some pretty solid economic foundations. The concept of user cost itself. That actually goes back to John Maynard Keynes talking about industrial equipment wearing out.
Okay, so depreciation, basically.
Exactly. But the real application to natural resources, that was pioneered by Salah El-Serafai. He formalized how to apply this idea to things like mines and oil wells. And it all ties back to a core concept from economics, Hicksian income.
Hicksian income. Remind us.
It's about defining income as the maximum amount you can consume today without making yourself worse off, without reducing your ability to consume the same amount tomorrow, maintaining capacity.
Got it. So sustainable consumption.
Precisely. And this framework we're looking at, it's broad. The research outlines 8 different dimensions, not just minerals.
8. Like what?
Things like the carbon budget, treating the atmosphere's capacity as a finite resource too. And human capital, even social capital. It's comprehensive.
Wow. Okay. That sounds like a fundamental rethink of, everything on a balance sheet. But for today's deep dive, we're going to zero in on one specific, absolutely critical piece of this puzzle.
Which is?
The sustainability weighted cost of capital, or SWAY-ACC. This is the engine driving the whole calculation, isn't it?
It really is. The SWAY-ACC is where the hard financial numbers meet these broader sustainability goals. It's the formula that dictates how much capital needs to be set aside.
By blending what the company needs in terms of returns with what society needs for the long haul.
Exactly. It balances the corporate demand for high returns with the societal need for capital maintenance over time. It's the key variable that makes the whole system work, makes it adjustable.
So understanding SWAY-ACC is crucial to understanding this whole user cost idea. Let's get into it. Okay, let's lay the groundwork properly. Why are the big accounting standards, GAAP and IFRS, not fit for purpose when it comes to non-renewable resources?
Yeah, the fundamental failure, it really comes down to their reliance on historical cost accounting.
Historical cost, meaning what they paid for it way back when.
Exactly. Think about a factory. They buy a machine for, say, $10 million. They depreciate that cost over the machine's useful life, maybe 10 years. That makes sense, right? You're just spreading the original purchase price.
Yeah, straightforward. Matching expense to revenue.
Now, try applying that same logic to a copper mine. Maybe the company bought the land and mineral rights back in the 1980s for, $100 million. Under traditional accounting, they use something called the units of production method.
Okay.
Which means they deplete that original $100 million historical cost bit by bit based on how much copper ore they dig up each year.
So they're just writing off the initial purchase price.
Precisely. But they are completely, utterly ignoring the economic loss happening today. The actual value of that copper in the ground might have shot up, and more importantly, once it's dug up, it's gone forever.
The opportunity cost, the loss of future potential extraction, it just vanishes from the books.
It's never recognized. So a company can look incredibly profitable, reporting huge income, while, as the research puts it, they're effectively liquidating its resource assets.
Selling the family silver again.
Exactly. And the consequence is huge. If you're not deducting that real economic loss, you're systematically treating the cash from selling off a finite asset as if it's pure distributable profit.
Which misleads everyone involved. Investors, governments.
Everyone. It gives a false picture of the company's long-term health and the sustainability of those earnings. It fundamentally undermines the whole idea of capital maintenance.
Yeah, that makes sense. Like, if I run a taxi company and sell one of my cars for cash, I can't just call that pure profit, can I? I need that cash to eventually buy a new taxi to stay in business.
That's the perfect analogy. And if a mining company extracts ore, the value of that natural capital needs to be replaced with some other form of capital to maintain capacity.
Which brings us to the proposed solution, this user cost concept.
Right? The user cost idea, formalized by Aldhaferi, shifts from that historical cost view to a value-based approach. It says, look, when you get revenue, let's call it R, from extraction,
Okay, R for revenue.
only a certain fraction of that R, let's call it X, is actually true, sustainable income that you can consume or distribute.
And the rest.
The rest, the difference, R minus X, that's the user cost, that's the capital component. It represents the economic depreciation, the value lost from using up the natural asset. It must be set aside.
And it's not just about saving the cash in a mattress, right? The point is to reinvest it.
Absolutely critical. It has to be reinvested into what we call reproducible capital. This ties directly into a really foundational idea in sustainability economics called Hartwick's rule.
Hartwick's rule.
Yeah, Hartwick showed mathematically that if an economy takes all the rent, the true value captured from extracting a resource, and invests it all into reproducible capital.
Like factories, infrastructure, technology.
Exactly, things we can build and rebuild. If you do that, then the level of consumption for future generations can actually be maintained indefinitely, even as the original resource runs out.
Wow. So user cost accounting basically takes Hartwick's rule for a whole economy and applies it down to the level of a single company.
That's the goal. The company has to invest that user cost amount into new productive assets, maybe green technology, diversifying into renewable energy, or finding and developing completely new reserves. The point is, when the original mine or oil field is exhausted, the company's income-generating capacity continues.
Okay, let's get into the nuts and bolts. How do you actually calculate that split between income X and user cost, RX? You mentioned Aldhaferi's formula.
It's surprisingly elegant, Ashley. You only need three main inputs to figure out the sustainable income portion, X.
What are they?
First, the total resource revenue itself, R. Second, the expected remaining life of the resource, like how many years the mine can keep producing, which we call N.
Okay, R and N.
And third, the really crucial one, the appropriate rate for reinvestment, which is essentially a discount rate. We call this R.
RN and R. Got it. And the formula uses these two.
The formula calculates the sustainable income X in such a way that if you take the user cost portion, R minus X, and reinvest it every single year at that rate R for the remaining years, the fund you build up by the end of year must be large enough to spin off an income equal to X forever after that, just from the returns on that fund.
Whoa. Okay, so it's mathematically forcing the company to save enough to create a perpetual income stream to replace the one that's disappearing.
Exactly. It guarantees the maintenance of income capacity, mathematically.
Can you give us a feel for the numbers? Like, how big is this user cost fraction typically?
Sure. Let's use the example scenario from the source material. Suppose you have a resource, maybe an oil field, that's expected to last for 20 years. So N equals 20.
Okay, 20 years.
And let's assume the appropriate reinvestment rate, the discount rate R, is 5%.
N20, R 5%. What does the formula say?
When you plug those numbers into Aldhaferi's model, it dictates that roughly 37.7% of the total revenue collected that year must be classified as user cost.
37.7%. So nearly 40 cents of every dollar that traditional accounting might call profit has to be recognized as capital depletion and set aside.
That's right. It's a significant adjustment.
Why so high?
Well, think about it. If your asset is only going to last 20 years and your expected return on reinvestment is a moderate 5%, you need to save a pretty substantial chunk each year for those 20 years to build up a big enough pot to live off the interest indefinitely. If you save any less than that 37.7%, the fund you build will eventually run out. Your income capacity falls off a cliff after year 20. That 37.7% is the bare minimum needed to maintain capital in that scenario.
That's the economic reality that current accounting just ignores.
Completely ignores.
So how big is this illusion of profit in the real world? You mentioned the research looked at national accounts.
Yeah, and the findings from applying this logic to national economies are genuinely startling. It shows just how much we overestimate economic performance by ignoring resource depletion.
Give us an example. Peru, I think, was mentioned.
Yes, Peru. Looking at the periods from 1992 to 2006, when economists went back and adjusted Peru's national accounts to deduct the value of the minerals extracted.
What happened?
The conventionally measured GDP contribution from their mining sector was found to be overstated by somewhere between 31% and 51%.
A third to a half.
A third to a half of the reported growth from mining wasn't really growth in sustainable income. It was just drawing down the national savings account, liquidating the country's mineral wealth. Think about the policy implications of getting that number wrong.
Absolutely. And Chile, as a huge copper producer.
The Chile example is even more dramatic. It's almost hard to believe. For the 20 years from 1995 to 2015, if Chile had applied proper depletion accounting, using user cost principles to its massive copper mining sector, the calculated GDP contribution from mining would have been reduced by almost 98%.
98%.
98%. It suggests that nearly the entire reported economic output from copper mining over 2 decades was, in true Hicksian income terms, just the consumption of national capital wealth, not the creation of new sustainable income capacity.
That is staggering. It fundamentally reframes the entire narrative around resource extraction and development.
It absolutely does, and it underscores just how vital a framework like user cost accounting is. If companies were required to report using this method, these huge overstatements of profit would become immediately visible on their financial statements.
Forcing everyone, managers, investors, governments, to confront the true economic cost of digging stuff out of the ground.
Precisely. No more illusion.
Okay, that brings us right back to that crucial variable R, the discount rate. You said the 37.7% user cost in the example depended entirely on assuming R was 5%.
That's right. Change R, and that user cost percentage changes, potentially by a lot.
And this is where the SWICC framework comes in. It's designed to figure out what the right R should be for calculating that user cost, isn't it?
Exactly. The Sustainability Weighted Cost of Capital, SWESBCC, is the mechanism for determining the effective discount rate, let's call it RF, that should be used in the El-Serifé calculation.
So why is R so pivotal? Remind us of that relationship again.
Okay, so RR represents the assumed rate of return you'll get on the money you set aside, the user cost, and reinvest. It reflects how quickly your savings are expected to grow.
And that affects how much you need to save today.
Massively. It's an inverse relationship. If you assume a very high discount rate, or say 10 or 12%, you're basically saying my reinvestments are going to grow really fast.
Like a high yield investment.
Right. And because you expect such fast growth, you only need to set aside a relatively small user cost amount today to reach your target future fund size. The high returns do the heavy lifting.
Okay, high R, small user cost today. What about a low R?
Conversely, if you use a low R, maybe 2 or 3%, you're assuming your reinvestments will grow slowly, like putting money in a low-yield savings bond.
Right.
To reach that same perpetual income target with slow growth, you had to compensate by saving a much larger user cost amount today. More savings needed up front. Low R, large user cost.
Okay, that makes sense. And this sets up a fundamental conflict, doesn't it, between how a company might see things and how society might.
Absolutely. That's the core tension the SWBC is designed to manage. On one hand, you have the private rate, let's call it, or corp.
That's the company's perspective.
Yeah, typically it's the company's own weighted average cost of capital, their WACC. This reflects what their shareholders and lenders demand as a return for the risk they're taking. And it's usually quite high, maybe 8, 10, even 12% in real terms.
Because investors want strong returns fast.
Exactly. But using that higher core in the user cost calculation leads to a low user cost charge, encouraging faster depletion because the future loss is heavily discounted.
And on the other side?
On the other side, you have the social rate, or social. This reflects society's longer-term perspective. It considers things like intergenerational equity, our responsibility to future generations.
So it values the future more highly.
Generally, yes. The social rate is typically much lower, maybe 2, 3, 4% real. It reflects the idea that society should discount the future as heavily as a corporation focused on quarterly returns might.
But if you used only that low social rate...
If you used only the low social, the required user cost would be very high, potentially making projects look unprofitable from the company's point of view, even if they're viable.
So you're stuck. High corporate rate depletes too fast. Low social rate might stifle investment.
That's the dilemma, and this is precisely where the SWBC formula provides a solution. It creates a blended effective rate, RF, that sits somewhere between the purely corporate and purely social rates.
Okay, give us the formula. How does it work?
It's actually quite straightforward. The formula is RFNF 1R dot plus ROC social.
Okay, RAF equals 1 minus lambda times R SAP plus lambda times R social, What's lambda? That Greek letter seems pretty important.
Lambda is the heart of it. It's the sustainability weighting factor. It's a number between 0 and 1.
0 to 1. And what does it represent conceptually?
It represents how much weight the company, or regulators if it's mandated, chooses to give to the long-term societal perspective versus the short-term corporate perspective in its financial planning. It quantifies the commitment to sustainability.
Okay, so let's walk through the extremes. What if a company says, we only care about shareholder returns right now? What's lambda?
If they take that purely corporate view, they set up equals 0.
Lambda equals 0. And the formula?
If lambda is 0, the one term becomes 1, and the second term, risk social, becomes 0. So the formula just simplifies to up F, S, or corp.
So business as usual, the effective rate is just the company's normal WACC.
Exactly. This results in the lowest possible user cost charge and the highest reported short-term profit. It reflects minimal concern for long-term capital maintenance beyond the corporate hurdle rate.
Now, the other extreme. What if a company makes a maximum commitment to sustainability and future generations?
Then they would choose 1. Lambda equals 1. How does that change the math?
If lambda is 1, the first term, 1 or core, becomes 0, and the second term becomes 1R social. So the formula simplifies to RIF is were social.
So the effective rate becomes the low socially conscious rate.
Correct. This leads to the highest possible user cost charge, the lowest reported sustainable profit for the current period, but it ensures the maximum possible capital is being set aside for the future. It prioritizes conservation and intergenerational equity.
But hang on, couldn't the company just game this? Who decides what the social rate actually is? Couldn't they just pick a conveniently high social rate close to their corporate rate to keep lambda high but the user cost low?
That's a really important practical question, and the answer lies in transparency and justification. The framework doesn't necessarily prescribe one specific social rate, but it insists that the chosen R social must be based on credible external benchmarks.
Often, it would reference rates used by governments for evaluating long-term public projects, or rates derived from climate economic models that consider long-term damages. These typically fall in that low single-digit range, say 2 to 4%.
So a company couldn't just invent a high social rate.
They'd have a very hard time justifying it. If a company claimed their R social was, say, 7%, they'd have to publicly explain why their view of societal preference and intergenerational equity aligns with such a high discount rate for the future. It wouldn't pass the sniff test.
So the WACC framework doesn't eliminate judgment, but it forces the judgment call, the choice of lambda, and the justification for our social out into the open.
Exactly. It makes the underlying values explicit and contestable. That transparency is key.
And I noticed the framework suggests lambda shouldn't necessarily be static. It can change over time.
Yes, that's a crucial dynamic element. Lambda should be adjusted based on changing circumstances. Think about it. As a company gets closer to resource limits, maybe their mine only has 5 years of reserves left instead of 30, or they're about to hit their allocated carbon budget under climate targets, the sustainability risk becomes much more acute.
Right, the cliff edge is approaching.
So in those situations, lambda should automatically increase, moving closer to 1. This forces the effective rate RF downwards towards the social rate.
Which means
the required user cost charge goes up, signaling the increasing scarcity and forcing management to urgently prioritize finding replacement capital or transitioning the business before the asset is completely depleted. It's a built-in financial early warning system.
Okay, this is making sense. Let's make it really concrete. The research uses Freeport-McMoRan, the big copper and gold miner, as a case study. Let's run their numbers through the Sella CC.
Okay. The study assumes Freeport's corporate rate, R-Core, is around 8% real, and it uses a benchmark social rate, R-Social, of 3% real.
R-Core 8%, R-Social equals 3%. Now, what if Freeport decided to strike an even balance? Set lambda equals 0.5.
All right, lambda 0.5. We plug that into the formula. RA Bowie enough 1.58% plus 0.53%.
So that's half of 8% plus half of 3%.
Which is 4% plus 1.5%, giving an effective discount rate, RAF, equals 5.5%.
Okay, so the blended rate is 5.5%. Now, how does that rate affect the user cost calculation? Let's assume Freeport has a reasonably long reserve life, say 25 years, N25.
Right, so we take RA5, 5.5%, and N equals 25, and feed them into the El-Serify model we discussed earlier.
And the result. How much of their resource cash flow is user cost?
With those inputs, the required user cost comes out to approximately 26.2% of their resource income. The study uses EBITDA as the base for resource income. We can talk about why later.
Over a quarter of their operating cash flow, just from choosing a middle ground lambda of 0.5.
Yep. Now, contrast that. What if they ignored the social aspect entirely? Set lambda as 0.
Then RF would just be their 8% WACC.
Correct. At our 8% at N25, the user cost drops significantly, down to about 16.5% of EBITDA.
Wow, that's almost 10 percentage points less. That's a huge difference in cash flow available for other things, just based on choosing lambda 0.
It is. It frees up potentially billions for dividends, buybacks, whatever, simply by discounting the future more heavily.
And the other extreme, if they fully embrace the social perspective, lambda will 1.
Then RF becomes the social rate of 3%. At our 3% and ND25, the user cost calculation shoots way up to approximately 39.7% of EBITDA.
Nearly 40%. So the gap between lambda 0, 16.5% cost, and lambda 1, 39.7% cost, really quantifies the financial impact of prioritizing long-term sustainability.
It absolutely does. That 23 percentage point difference in required savings is the monetary value the company places, implicitly or explicitly, on intergenerational equity versus current returns.
Interestingly, the study itself, when applying this to Freeport, didn't use 0.5 or 0 or 1. They ended up using an RF of around 6.86%.
That's right. Which, if you work backwards with the 8% and 3% rates, implies they chose a lambda of about 0.3. So still giving more weight to the corporate rate than the social rate, 70-30 weighting.
And even that relatively modest sustainability weighting, lambda 0.3, resulted in a user cost charge of around 19% of Freeport's EBITDA.
Which is still a substantial charge, much larger than traditional depletion, demonstrating that even a small shift towards acknowledging sustainability via lambda has significant financial consequences. It highlights the sensitivity.
So at the end of the day, the SWFCC isn't about finding one single correct lambda value that applies to everyone.
Not necessarily. The primary goal is transparency. Companies using this framework must disclose the lambda they chose, the row core and row social they used, and justify those choices.
And the idea of multi-scenario reporting.
That's highly recommended. Companies should show what their sustainable income would look like under different lambda scenarios. Say lambda equals 0, lambda equals 0.5, and lambda was 1.
Why?
Because it allows investors and stakeholders to see exactly how sensitive the company's reported earnings are to different assumptions about sustainability. It turns a hidden, implicit value judgment into an explicit, measurable factor in the financial statements. WACC makes the trade-offs clear.
Okay, so we've seen how SWICC determines the user cost rate. Now let's see the impact on the actual financial statements. This is where theory hits the books, right? The research does this for Freeport's 2023 results.
Yes, this is the crucial output. The framework mandates creating a side-by-side comparison. The traditional income statement, let's call it View A, and the sustainable income statement, View B.
And the big difference in View B is?
The big difference is a new, significant expense line item right in the operating section, user cost, natural capital depreciation. For Freeport in 2023, using the SWICC derived rate, based on that lambda 0.3 RFS 6.86%, this charge amounted to a massive $1.586 billion.
Wow, $1.6 billion. That's what, about 7% of their total revenue for the year?
Roughly, yes. It's a material number.
Now, before we trace the impact down to profit, you mentioned the calculation uses EBITDA as the starting point for applying the user cost percentage. Can you quickly clarify what EBITDA is and why use that?
Sure, good point. EBITDA stands for earnings before interest, taxes, depreciation, depletion, and amortization.
Okay, quite a mouthful.
It is. But it's basically a proxy for the company's raw operating cash flow generated from its assets before accounting for any of the standard non-cash charges related to the consumption of those assets, like D&A or financing costs and taxes.
And why is that the right base for the user cost?
Because we want to capture the total cash generated by liquidating the natural resource itself. Traditional depletion is one of those DDA charges, and we've already established it's flawed because it's based on historical cost. So in the sustainable view, View B, we effectively ignore the traditional small depletion charge and instead deduct our much larger economically meaningful user cost figure from that EBITDA base to arrive at a sustainable operating profit.
Got it. So looking at Freeport's numbers, in View B, you scrap their old depletion charge, which the paper notes was about $589 million, and instead subtract the $1.586 billion user cost.
Precisely. The net effect is a much larger deduction from operating cash flow, and that hits the next line down immediately. Operating profit, or EBIT, earnings before interest and taxes.
How big was the hit to EBIT?
Freeport's traditionally reported EBIT was $6.225 billion. In the sustainable view, View B, After subtracting the larger user cost, their EBIT drops to $5.228 billion.
That's $1 billion lower. About a 16% reduction in operating profit.
A very significant reduction, yes.
Now, the framework treats this user cost as a tax-deductible expense, like traditional depreciation or depletion, right? So there's a tax shield effect.
Correct. The higher user cost expense reduces the taxable income, so the company pays less tax in the sustainable view compared to the traditional view.
But even accounting for that tax benefit, the bottom line, net income, must still take a hit.
Absolutely. The tax shield softens the blow, but it doesn't eliminate it. Freeport's traditionally reported net income was $3.751 billion. In the sustainable view B, it falls to $3.121 billion.
Still a drop of over $600 million, about a 17% reduction in the final reported profit.
Exactly. And that difference, roughly $630 million after tax, is the key takeaway. That $630 million represents the portion of traditionally reported profit that actually came from consuming irreplaceable natural capital.
And the crucial implication is?
The crucial implication under this framework is that this $630 million is not freely distributable profit. It shouldn't be paid out as dividends or used for share buybacks.
Because it wasn't truly earned in a sustainable sense?
Precisely. It represents the capital that needs to be retained and reinvested to maintain the company's future income-generating capacity. The framework essentially tells management and shareholders, this part of the profit is actually the seed corn for next year's harvest. You can't eat it.
Imagine that conversation in a boardroom. Sorry, folks, that extra dividend you were expecting, it's actually our natural capital replacement fund.
It forces a fundamental shift in perspective and capital allocation priorities. It makes the long-term trade-off explicit in the here and now.
And how is this obligation tracked? It can't just be a number on the income statement that disappears.
No, it needs to be anchored on the balance sheet. The framework requires that the cumulative user cost charges over time be recorded in a specific equity reserve account, the Natural Capital Replacement Reserve. This reserve account acts as a visible, auditable tracker of the company's accumulated obligation to reinvest those funds. It shows stakeholders exactly how much capital should be available for replacement projects.
So it ensures the user cost isn't just an accounting fiction, but represents a real pool of capital earmarked for a specific purpose.
That's the intent. It links the accounting adjustment directly to the expectation of future action.
Which brings us to the next logical step. The accounting shows the need to reinvest. How does the framework measure whether the company is actually doing it effectively?
That's where the reinvestment scorecard comes into play. It's the performance management part of the framework. It evaluates how well the company is converting those resource rents, represented by the user cost reserve, into new, sustainable, reproducible capital.
Okay, so it grades their reinvestment efforts. What are the key metrics on this scorecard?
The scorecard detailed in the research uses three main metrics, classifying performance on each as high, moderate, or low.
Metric number 1.
Metric 1. Sustainable diversification of CapEx. This looks at what percentage of the company's total capital expenditure, CapEx, is going into genuinely non-extractive sustainable projects.
Such as?
Things like building renewable energy capacity, solar, wind, investing in circular economy initiatives, significant land rehabilitation beyond basic compliance, or developing technologies for mining future-facing commodities like battery metals with a lower footprint.
And what are the performance thresholds?
They're designed to be quite demanding. High performance requires more than 30% of total CapEx going into these sustainable diversification areas. Low is anything less than 10%.
How do the case study companies stack up here?
Well, it shows a stark contrast. Freeport, being heavily focused on its core copper and gold mining, typically allocates 5% or less of its CapEx to such diversification, so firmly in the low category.
And big oil.
Even the major integrated oil and gas companies, despite headline announcements, are often only allocating around 10% to 15% of their CapEx to low-carbon or renewable projects. That puts them barely into the moderate category, maybe at the low end. Compared to a company like Ørsted, the Danish energy giant. They made a deliberate strategic shift, selling off all their oil and gas assets. Now, virtually 100% of their CapEx goes into offshore wind. They're off the charts, beyond high on this metric.
So that metric captures the degree of strategic transformation. What's the second metric?
Metric 2, reserve replacement rate, or RR. This is a more traditional metric for extractive companies, but still crucial for assessing capital maintenance within their core business, at least for the finite resources.
What does it measure?
It's the ratio of new reserves the company adds during the year, through exploration success or acquisitions, divided by the amount of reserves it extracted or depleted during that same year.
So is it finding new stuff faster than it's using up the old stuff?
Basically, yes. High performance here is typically defined as an RRR greater than 120%, meaning adding 20% more than depleted. Consistently below 100%, let alone below 80%, means the physical asset base is shrinking.
In the findings here.
The research notes that Anglo American, for example, showed strong performance, high RRR, in copper, largely thanks to bringing their big Quellaveco project online, which significantly boosted their copper reserves. But there's nuance here too. If a company strategically exits a high-carbon resource like thermal coal, as Anglo did, their RRR for coal would plummet. But that might be a good thing from a sustainable capital maintenance perspective if they're replacing it with lower carbon assets. The context matters.
Okay, makes sense. And the third metric?
Metric 3, reinvestment rate financial. This one links CapEx back to the cash generated by the resource itself. It calculates the ratio of total capital expenditures divided by the cash flow generated from depletion-related activities, approximated by EBITDA or a similar measure. It asks, how much of the cash generated by selling the finite resource is actually being plowed back into maintaining or replacing productive capacity?
And what's considered good or bad here?
Low performance is defined as a reinvestment rate below 50%. That means the company is paying out more than half of the cash generated from resource depletion as dividends or buybacks, rather than reinvesting it.
Prioritizing immediate shareholder returns over long-term capital maintenance.
Exactly. We often see this pattern during commodity price booms. The research suggests both Freeport and Anglo have sometimes fallen into this low category during peak price periods, choosing large payouts over maximizing reinvestment.
And Ørsted?
Ørsted, during its transformation phase, consistently maintained a high reinvestment rate, often well over 100%, meaning CapEx exceeded cash flow funded by debt or equity because they were aggressively building out their new renewable asset base. Total commitment to reinvestment.
So pulling the scorecard together for the three companies.
You see a clear spectrum. Freeport, largely focused on optimizing existing copper-gold operations, resulting in mostly medium-low scores on diversification and reinvestment rate, depending on the cycle. Anglo American, showing more transition with strategic divestments, coal, and major investments in future metals. Copper, RRR high, setting net zero goals, placing them more in the moderate mixed category. Ørsted, high across the board, a textbook example of radical reinvestment and business model transformation away from finite resources.
And crucially, the market seems to be noticing this difference.
Increasingly, yes. The market differentiation is becoming apparent. Ørsted stock initially saw phenomenal growth after its IPO. Its total shareholder return far outpaced traditional energy and mining peers for a long time. Investors were rewarding the clarity and commitment of its sustainable transition.
While companies like Freeport and Anglo remain much more tied to the volatile swings of commodity prices.
Exactly. Their valuations are still heavily dependent on the price of copper or iron ore that day. The SOACC framework and the reinvestment scorecard provide a financial language to explain why a company like Ørsted might deserve a valuation premium. Its reported profits, adjusted for user cost, are arguably more sustainable and less dependent on liquidating finite capital because they demonstrate a commitment to replacing it.
Now, this user cost idea is powerful for minerals and fossil fuels, but the research argues it doesn't stop there. It needs to apply to all forms of capital needed for sustainable income. Let's talk about the carbon budget.
Yes, the analogy is quite direct and increasingly relevant. If the world is serious about climate targets, like limiting warming to 1.5 degrees Celsius, then the atmosphere's remaining capacity to absorb co-zero without exceeding that threshold is effectively a finite global resource.
Like a shared ore deposit in the sky.
Exactly. And just like digging ore depletes a mineral reserve, emitting a ton of co-zeros depletes the remaining global carbon budget. It uses up future emissions potential.
So companies need to account for using up their share of this atmospheric reserve.
That's the argument. Companies, especially carbon-intensive ones, should calculate their specific allowed emissions quota based on science-based targets aligned with the global budget. Every ton they emit uses up part of that quota, and this should trigger a carbon depletion charge on their sustainable income statement.
Turning an environmental limit into a financial cost. How do you put a dollar value on depleting the carbon budget?
You need an internal carbon price. This price should ideally reflect the estimated future cost of abatement, carbon removal, or the societal cost of climate damages. It's a way to monetize the use of that atmospheric capacity.
The research used an example for Anglo-American.
Yes. Anglo emits roughly 4 million tons of Scope 1 and 2 CO euros equivalent per year. If they were to adopt a, let's say, moderate internal carbon price of $50 per ton,
Right.
that translates directly into a notional annual carbon depletion cost of $200 million, 4 million tons, 50 ton. This $200 million would need to be deducted when calculating their sustainable income.
Treating the use of the climate budget as a real operating expense.
Precisely. And just like the SLAO ACC rate, the choice of the internal carbon price is critical and needs justification. If they used a higher price, say $100 per ton, which some companies are moving towards,
That cost doubles to $400 million.
instantly. So the internal carbon price becomes a key indicator of how seriously the company is taking the maintenance of climate capital.
For oil and gas companies, applying this logic seems particularly brutal, especially regarding their booked reserve.
Oh, absolutely. This leads directly to the issue of stranded assets. If a significant portion of an oil company's proven reserves are deemed unburnable under a 1.5 degrees C or 2 degrees C scenario, meaning extracting and burning them would violate the global carbon budget.
Yeah.
Then the user cost framework implies those unburnable reserves represent depleted or inaccessible capital. Their value should be written down now, impaired on the balance sheet, or excluded entirely from the calculation of sustainable income and reserves.
Which is very different from current practice, where they often carry these reserves at full value until the very last minute.
Exactly. Sustainable accounting forces a much earlier recognition of the climate transition risk embedded in fossil fuel assets.
Okay, beyond natural resources and carbon, the framework pushes further into human and social capital. Let's start with the human capital user cost.
The argument here is that a company's workforce, its skills, health, morale, safety, is also a form of capital that can be depleted
How does it get depleted?
through things like excessive employee turnover because of low pay or poor conditions, lack of investment in training leading to skill gaps, high rates of workplace injuries or illness, chronic burnout, poor safety culture. If a company cuts corners on wages, benefits, training, or safety,
They might boost short-term profits.
but they are effectively liquidating the long-term capacity and well-being of their workforce. This depletion has real, though sometimes delayed, financial costs.
Can we quantify those costs?
We can start to. The research cites estimates, for example, that the total societal cost associated with a single workplace fatality in the U.S. mining industry is around $1.42 million, factoring in medical costs, lost productivity, insurance, legal liabilities, reputational damage, etc.
So the framework suggests the company should account for this risk proactively.
Yes. A company with, say, a poor safety record or unusually high attrition rates should calculate a human capital user cost. This represents the investment needed today in things like better safety protocols, improved training programs, mental health support, or more competitive compensation, specifically to offset the measured or anticipated depletion of their workforce capacity.
And if they don't make those investments,
Then the calculated human capital user cost still gets charged against their sustainable income, reflecting the fact that they are generating current profits at the expense of future workforce stability and productivity.
right. And the final category, social capital user cost. This sounds a bit more abstract.
It can be, but it's incredibly important, especially for extractive industries. Social capital refers to the trust, goodwill, and positive relationships a company has with the local communities, governments, and other stakeholders where it operates, essentially its social license to operate.
And this can be depleted too.
Definitely. Through things like environmental damage that harms communities, breaking promises about local employment or benefits, lack of transparency, perceived unfairness, or ignoring local concerns, when this social capital erodes.
The costs can be huge even if they don't appear on a traditional balance sheet initially.
Exactly. Think about protests blocking access to a site, lengthy legal challenges, difficulty getting permits for expansion, government interventions, or outright strikes. The research uses the example of a strike at a Newmont mine in Mexico.
What was the estimated cost?
Reports suggested it cost the company around $3.7 million per day in lost revenue. That's a massive direct financial consequence stemming from depleted social capital in that case, a labor dispute rooted in profit-sharing disagreements.
So how does the user cost framework handle this?
It proposes that companies should proactively calculate a social capital user cost, perhaps as a required percentage of their resource rent or revenue, maybe 1 or 2%. These funds must then be demonstrably invested in initiatives that maintain or enhance social capital. Things like community development projects, local infrastructure improvements, transparent engagement processes, or environmental stewardship beyond basic compliance.
And again, if they fail to make these minimum investments.
The shortfall is charged as a social capital user cost against sustainable income. It forces management to recognize that neglecting community relations isn't saving money, it's depleting a critical asset that carries significant financial risk.
Quantifying human and social capital depletion accurately must be really challenging, though. Much harder than counting tons of copper.
Oh, absolutely. It's the hardest part. You often need to rely on proxies, things like employee turnover rates, safety incident frequency, community investment budgets as a percentage of revenue, stakeholder perception surveys, the number of active grievances or legal challenges.
So the numbers might be estimates.
They might be estimates or based on these proxies. But the core value of including them in the user cost framework, even if imperfectly quantified initially, is that it forces these critical issues onto the CFO's agenda. They become financial risks to be managed, tracked on the balance sheet via the replacement reserve, rather than just reputational issues handled by the PR department.
It makes the maintenance of all critical capitals natural, carbon, human, and social, an integrated part of measuring true sustainable profit.
That's the ultimate goal. If you're boosting profits today by running down any of these essential assets, the comprehensive user cost framework ensures that unsustainable profit is correctly identified and adjusted downwards.
Okay, this framework is comprehensive, maybe even revolutionary, but it involves things like companies choosing their own lambda, setting internal carbon prices, estimating social capital costs. Doesn't this open the door wide to potential greenwashing or manipulation? How do you ensure the numbers are trustworthy?
That's the million-dollar question, or perhaps the billion-dollar question given the stakes. And the research is clear. This framework only works if built on a foundation of robust data verification and trust. Self-reporting without rigorous checks is insufficient.
So what's the proposed solution for building that trust?
Technology plays a key role. We need systems that provide immutable audit trails, not just for the sustainability metrics themselves like emissions or reserves, but critically for the flow of funds related to the user cost.
You mean tracking that natural capital replacement reserve we talked about?
Exactly. You need irrefutable proof that the, say, $1.586 billion Freeport calculated as user cost was actually set aside in that reserve account and then demonstrably spent on legitimate capital replacement or diversification projects, building a solar farm, funding land rehabilitation, investing in new exploration, and not just, shuffled around internally or paid out through the back door.
This sounds like a job for blockchain.
It's a very strong potential application. A permissioned blockchain, shared perhaps between the company, its auditors, and maybe even regulators, could provide that immutable, time-stamped ledger tracking the user cost from calculation to reservation to final expenditure on approved projects. It creates verifiable proof of reinvestment.
Beyond tracking the money, what about verifying the underlying ESG data itself? Emissions numbers, safety stats, community investment figures.
Here, too, technology offers solutions beyond just trusting the company's PDF report. The research mentions concepts like data trusts and decentralized identity, DID, combined with verifiable credentials.
How does that work?
Think of the Energy and Mines Digital Trust EMDT pilot mentioned in the sources. A company could get its key ESG metrics, say its water usage intensity or its verified Scope 1 emissions for the quarter, certified by a trusted third-party auditor. This certification is then issued as a secure, tamper-proof digital credential.
Like a digital passport for their ESG data.
Exactly. The company can then share this verifiable credential with investors, lenders, or regulators. The recipient can instantly verify the authenticity of the credential and the integrity of the data using blockchain or other distributed ledger technology without needing access to the company's raw, sensitive internal data.
So it moves from trust us, here's our report, to verify this digitally signed credential from our auditor.
Precisely. It builds trust through cryptographic proof and third-party validation, making greenwashing much harder.
Okay, so if the technology exists or is emerging to make this framework trustworthy, what needs to happen on the policy front to actually get companies to adopt it? It's a big shift from current practice.
It is. Voluntary adoption will likely be slow and patchy. The research argues that driving widespread adoption requires clear signals and mandates from policymakers and standard setters. It outlines 3 key policy recommendations.
Let's hear them. Recommendation number 1.
Recommendation 1. Mandatory reporting. Financial regulators, bodies like the SEC in the U.S., or equivalent authorities globally need to step up. They should mandate that extractive companies, and potentially other high-impact industries, publish a supplemental statement of resource earnings and reinvestment alongside their standard financial statements.
And this statement would show.
It would have to transparently disclose the key parameters of the user cost calculation, the chosen simple AAC rate, including the lambda factor and the underlying R core and R social, the resulting user cost charges broken down by capital type, natural, carbon, human, social, and crucially, a clear reconciliation showing how you get from traditional net income to the adjusted sustainable net income figure.
Just mandating that disclosure would force the issue onto the table for every company?
Absolutely. It makes the sustainability adjustments visible, comparable, and part of routine investor analysis.
Okay, what's recommendation 2?
Recommendation 2, fiscal incentives. Implementing user cost accounting means companies will report lower profits and face mandatory reinvestment obligations. This could put them at a competitive disadvantage, especially internationally, if others aren't doing the same.
So you need to level the playing field or cushion the blow?
Exactly. Governments should use tax policy strategically to support the transition. Specifically, they should offer targeted tax deductions or credits for those profits that are designated as user cost and demonstrably reinvested into approved sustainable capital projects.
Such as?
Investments in renewable energy generation, major energy efficiency upgrades, verifiable carbon capture or removal projects, significant community infrastructure linked to operations, or retraining programs for workers transitioning out of fossil fuels.
So the tax system would actively reward companies for making the sustainable reinvestments required by the accounting framework.
Yes. It aligns tax policy with the economic principle of capital maintenance. It makes the necessary reinvestment financially more attractive, or at least less punitive, rather than just being a mandatory cost. It turns the tax code into an accelerator for the transition.
Makes sense. And the third recommendation?
Recommendation 3, standard integration. This targets the accounting standard-setting bodies themselves, crucially. The International Accounting Standards Board, ISB, which sets IFRS used in much of the world, and the relatively new International Sustainability Standards Board, ISSB.
What should they do?
They need to formally integrate the principles of natural capital accounting and user cost into their official standards. This means updating existing standards on depletion and asset impairment, like IAS 16, IAS 36, IFRS 6, to require the calculation and disclosure of sustainable income metrics based on these concepts. And importantly, they need to mandate that these sustainability adjustments, including the user cost calculation and the reinvestment tracking, are subject to external assurance audited, just like traditional financial data, to ensure credibility and global consistency.
So embed it right into the core accounting rules everyone uses.
That's the ultimate goal. By pushing these 3 levers, mandatory disclosure, fiscal incentives, and integration into global standards, policymakers can shift sustainable accounting from being a niche academic proposal to becoming the mainstream reality of corporate financial reporting for resource-dependent industries.
Yeah.
Hashtag outro. So to kind of wrap up our deep dive today, this user cost accounting framework with the sustainability-weighted cost of capital, that's WACC, really at its core, offers what looks like a much more rigorous, transparent, and frankly economically honest way to deal with that systemic overstatement of profit we see in extractive industries.
Yeah, the SWECC mechanism, using that lambda factor, seems key because it provides that necessary flexibility. It allows companies, or perhaps regulators, to explicitly state their weighting between short-term corporate returns and long-term societal needs. And that choice isn't just philosophical, it translates directly, through the math, into a specific dollar amount, the user cost expense, that hits the income statement and dictates the minimum reinvestment needed to maintain capital, whether that's minerals, the climate, people, or community trust.
And the ultimate aim here really is a pretty radical shift in how we think about corporate value. The goal is to move beyond seeing sustainability as just an externality or a compliance checklist item. Instead, it becomes central to the financial calculation itself. Maintaining all forms of capital becomes the very basis for measuring a company's true, durable, long-term profitability. The companies that embrace this, the ones willing to adopt a higher lambda, make the reinvestments, maybe like Ørsted show their reported profits, are the ones that might actually stand the test of time.
Which brings us to a final thought for you, our listeners, to maybe chew on. Think about your own personal finances, maybe your retirement savings. Imagine your financial advisor gave you an annual income report, but they conveniently forgot to deduct the money you took out by selling some stocks or dipping into your savings principal. How much would you trust their report on your financial health? How sustainable would your future feel based on that inflated number?
It's fundamentally the same illusion the ass value CC and user cost accounting aim to eliminate at the corporate level for these industries. So we encourage you, maybe go look up the reports of some of the companies discussed, Freeport, Anglo American, and just ask yourself, what would their bottom line, their net income, really look like if they were required to use this framework with a high lambda, reflecting a strong societal commitment to the future? That difference between the profit they report today and that adjusted sustainable profit tells you a lot about their reliance on consuming finite capital versus generating truly lasting value.